thank you to everybody for joining us today. Looking forward to getting back into a rhythm here. But I am going to cover a couple of quick housekeeping items here up at the top. One is our friendly reminder that the content of the webinar is not investment advice. It's for educational purposes only. YCharts is not acting as an investment advisor here in any way. So please don't take anything we say here as a recommendation to go buy or sell any securities. Also, there will be a recording of the webinar available. So if you registered for this and you're unable to stick through the whole thing, check out our YouTube channel. Make sure to like and subscribe to that channel so you can see the recording, as well as catch up on any other webinars or content that YCharts published to our YouTube channel. So if you have questions today, we're going to try to get to those. Maybe we'll tackle some as we go, but we'll definitely try to save some time at the end. We've got a lot to cover, so can't make any promises, but we'll do our best. Please use the Q&A feature in Zoom for those questions, and we'll do our best to keep an eye on those. And another thing you'll notice today is that we've got a QR code on each slide here as we go through the webinar. Ooh, and if at any point you're motivated to go take a trial of YCharts and see what that's all about, you can click on that code and that'll get you right there. I think that's the important things that I was supposed to say before we do the fun stuff here, Charlie. But yeah, welcome back. So it's been maybe 6-7 months since we've done this, which is a little bit longer than usual. But yeah, you've been a little busy in the meantime. Charlie, see your title's changed. You're now the Chief Market Strategist at Creative Planning. So big move for you. I promise not to say congratulations, so I won't say congratulations. But happy for you and excited to have you back on. But anybody that does like to keep track of your content and be aware of your thoughts that you're sharing on an ongoing basis, is Twitter still the best place to do that, or how should people follow you now?
Yeah, absolutely. Twitter #1. Then we have YouTube channel, Creative Planning. I have my own channel as well, and Creative Planning website as well. So definitely reach out, follow us any of those places for more content like this. And really the goal is the same, just to try to help all investors try to make better investment decisions. That's what we're all about. And Creative Planning really thinks the way I do in terms of approaching that with investors. Everything's customized. It's not a one-size-fits-all approach. So yeah, check out all of that content for all of the good charts that you're going to see today and much more.
All right. Well, it sounds like we're aligned on the better investment decisions part of that. So Creative Planning and YCharts, similar goals. Good to hear.
Absolutely.
All right. Quick agenda today. So there's lots been happening. I feel like every time we get together, we never have a shortage of topics to cover. So we have to whittle it down to some things that we think are maybe most important. But we're going to talk about the end of easy money. We're going to talk about the anticipated recession and whether or not it was realized. We'll talk about the upside and downside of higher rates, talk about the housing market and all the fun things that have been going on there. And then some investing resolutions for life, which I'm excited to hear. And then, like I said, try to save some time for some Q&A at the end. Well, let's get into it. So, yeah, Charlie, the Fed's been more active than you since we last chatted. So catch us up.
Yeah, the Fed is doing kind of what they said they would do when they started this, which is they were going to fight the good fight until they felt the job was done. Very different Jerome Powell, right, than we saw a year before that, or even in late 2021 when you and I were doing these webinars and all the signs were pointing to higher inflation. And we were saying, well, what's going on? Why isn't the Fed doing anything about it? And they were just slow. They were just behind the curve and hoping it was transitory, and it didn't turn out to be, as we know. But once they started hiking last March, they became pretty aggressive, much more aggressive than they had predicted, than the market participants had predicted. Nobody was talking about 5% rates, and yet here we are 14 months later, 10 rate hikes, 500 basis points total. That's the fastest rate hike since the early 1980s, when Paul Volcker, who really broke the back inflation back then, was in charge. So really the question, Caleb, right today is this the end? And there's really two parts to that question. Was that the last rate hike? And secondly, is this the end of the easy money era that we've really become accustomed to since the financial crisis back in 2008?
good questions. I guess the answer maybe still be to be determined, but I guess it seems like these spreads always also become very interesting, right? What's the spread of the month or the spread of the quarter? But talk about this one. So comparing the Fed rates to your CPI change.
Yeah, so there's different ways, right? What is an easy Fed? What is a tight Fed? What is hawkish? What is dovish? There's all these crazy terms that people throw out. I like to keep it pretty simple. The way I look at it, a restrictive Fed is when the Fed funds rate is above the rate of inflation. And it took some time to get there, right? It took these past 14 months. But as we talked about on the last webinar, these two lines were likely to converge. We're likely to see Fed funds rate go up, CPI come down. At some point, they're going to meet. Well, finally, now we've crossed over that point. Now we're in restrictive monetary policy territory. And if you notice here, since 2010, that's been a real rarity, right? We've been in this period. So the Fed cut rates to zero back in 2008. And then the economy comes out of the recession in 2009. And what does the Fed do? They said, we're not going to do what we did in every other prior economic cycle, which is start to normalize policy. We're just going to leave interest rates at zero. And really the belief back then was under Ben Bernanke was really, there's no downside to that. Why not just keep easy money? That'll help asset prices go back up, housing prices in particular, stock market as well. And if people are feeling wealthier, they're going to spend more money. This became known as the wealth effect. It's going to help the economy and so on and so forth. So the Fed keeps it there for 7 years, and they don't start raising interest rates until the end of 2015. And when they do very slowly. And then we get to that point in late 2018 where the Fed does their final hike there, and they very aggressively, obviously, cut rates back to zero in 2020 after the COVID crisis. And so what we're seeing today, really the question is this a temporary phenomenon? Is this a temporary thing where the Fed is just fighting inflation for the moment, and the minute they see inflation, in their view, is not a problem anymore, they're going to cut rates again? Or is this going to revert back to, let's say, the 1990s or early 2000s when you did have the Fed funds rate really a more normal policy where it was actually above the rate of inflation for all of this period of time? And the interesting thing, Caleb, I think there's a lot of misperception in terms of market participants where they like to say that you need an easy Fed in order for the economy to be good, to the stock market to be good. Simply is not the case historically. We've seen the Fed funds rate above CPI for all of this history here. Economic growth was actually higher than it was during this decade of ultra easy money. And stock market returns, as you remember, during the 1990s were pretty good in spite of this policy. So I don't know the answer to that, but what I can tell you is the market is not expecting the Fed to go back to the days of the 1980s or 1990s. The market's saying this is going to be short-lived. And then when we get to September this year, just 4 months from now, the Fed's going to start cutting rates again.
The Fed tends to be reactionary, though, right? As opposed to saying, hey, what should we do if we don't have a catalyst for some kind of action? So that I think, even going into our next slide, right? You mentioned, I think last time we talked, right? The hikes are going to keep happening until something breaks, right? Until there's a catalyst to change that.
Yeah, that's what the last webinar we said exactly that, and now we have something that broke. And interesting that the Fed went through with the last two rate hikes in spite of these big bank failures. So now we have the second, third, and fourth largest in terms of asset size bank failures that we've seen in history occur in just the last 2 months. And so pretty interesting that the Fed, if you go back to 2008, when you had a whole lot of bank failures, you also had that in 2009. What was the Fed doing at that point? They were aggressively easing policy. Usually when there's a risk of a financial crisis, the Fed is easing policy. But today, so far, they're fighting the good fight. Powell saying, no, inflation's still the bigger concern. We had to do these last two rate hikes. I suspect, and we'll talk about that in a little bit, that the Fed is going to pause now at the next two meetings and then reassess things. But something has broken here. The question is if this continues, and what is the market really expecting with that rate cut in September? Is it simply that inflation's going to come down, which it's likely to do, and we'll talk about that as well? Or is it that the market's anticipating a recession or anticipating this banking crisis getting worse?
Speaking of anticipation, I think we were going to do a quick poll here too, right? Looking at the data here and talking about some of these banks that failed. And Charlie, I know you've done this poll in other forums, so I'll let you kick it off and we can see how our audience responds.
Yeah, so Gallup put out a big poll on this as well recently, just asking Americans about how they felt about money in their bank, right? It's just we saw really a crisis of confidence in these banks, right? They had assets that went down in value due to rising interest rates, and the response from depositors there was to flee these banks in the minute they thought there was trouble, right? So how worried are people about their banks? Well, in that recent Gallup survey, people are pretty worried, the most worried since 2008, I believe, in that poll. And after we get the results of the poll, we'll talk about whether people should actually be worried. Is this a valid fear, or most people worrying for no good reason at all?
I guess we can give people a few more chances to fill out this poll. I guess real quick while we do that. So last time we had you on, we did a poll.
I can't. Oh, I can't vote again. Right. I keep forgetting that.
Yeah, they don't let us vote.
I was gonna say. I was gonna do not worried at all, but
not worried at all. Yeah. I was just gonna do a quick look back on our last poll from October when we had you on. We asked everybody if they were bullish, bearish, or kind of neutral on where the stock market was going to go over 6 months, and we tend to be just past that window right now, I think. And I think a little over a third of our audience at that point was bullish. Another 25% or so was neutral, and I think 40% or so was bearish. So we tend to have a fairly bullish audience on these webinars, and maybe a pretty smart one too. So let's see what we voted for this time. Alex, can you give us the results?
Okay. 39. So that means most people are worried. Somewhat worried, a little bit worried, but not many people are very worried, but there is some worry out there. And I'll tell you why I wouldn't be worried at all for most people. And really that's most people don't have an account that's above that FDIC insurance limit. If you look at the median bank account balance, it's just a few $1,000s. Even the mean, if you look at the average, it's just 40,000. So even if you have money above that 250 limit, you could very easily diversify that across a number of banks. You could buy treasury bills directly. You could put money in a money market mutual fund that's segregated right from that financial institution. So there are very easy ways to diversify your risk. The incredible thing to me, Caleb, is that we still have this banking fear isn't going away. So we still have now currently PacWest seems to be the next bank that people are worried about. They just reported earnings and they said that they lost $5 billion in deposits. That wasn't surprising, but what was surprising was that they still had $8 billion in uninsured deposits at the end of the quarter out of the $28 billion, which made me question, what are those people thinking? What are they doing still having their money in this bank? I guess either they're assuming that they're going to be bailed out, similar to Silicon Valley Bank, or they're just saying that it's not a real risk, or it's just a lack of risk management, I guess, because it's very easy, right, to just move that money to a too big to fail bank or somewhere else. So I think the bigger question is, how does the FDIC resolve this? And they're going to have to do something, it seems like, because we keep once one bank fails, we're very quickly talking about the next bank at risk and the next bank after that. And Janet Yellen's comments that she made a month ago, very problematic, because they asked her essentially, well, how do you know whether you're going to protect the depositors or not? And she essentially said, well, if there's a systemic risk, we're not going to let that bank, the depositors, lose money. But if it's not, the implication is then they possibly could. And so therefore, after you say something like that, you either move your money to a too big to fail bank once you have that fear, or you move it into treasuries, but you're not going to if you think your bank's at risk, you're not going to keep it there, and that is going to keep escalating for these smaller banks, I think, until we have some type of resolution. So there's been a number of things proposed, either raising that FDIC limit or providing unlimited insurance, let's say for the next year or two. All of these suggestions, I don't think really resolve the root of the problem, which is there's a detachment from the depositor and the bank. There's not that skin in the game. So what I would prefer is when you open a bank account, you check a box. That box says either under that FDIC insurance limit, and so it's not applicable to me, or if I'm over, well, now you have the opportunity to purchase insurance directly from the FDIC. And if you don't purchase the insurance, well, then it's on you if the bank goes under, right? So that's what I prefer. I don't hear many people talking about that. And the reason why I prefer that is that simply then the people that are above the limit are paying the cost of that. Because if you do it the other way and you assess the banks a higher fee, they pass that on to everyone. And of course that they're not going to bear that cost. The end consumer is going to bear it. So hopefully something will be done. In the meantime, I think you're going to see this continue. And I guess the question from the Fed standpoint is, are they going to come in and save the day at a certain point and start cutting interest rates to help resolve this crisis? So we'll see what happens there.
It's funny to think about the Fed cutting rates and helping banks, right? Because this next slide goes into something, I guess, academically we've always heard, right? Rising rates are good for banks. It improves the margin that banks get on, lending versus deposits. Hasn't been true, right?
Yeah, be careful of these kind of one size fits all adages, right? Where it's easy. It sounds easy, right? Rising rates good for banks. The banks are making more money on their loans, and their deposit rates, they're very slow usually to raise them. So they're going to have this increase in net interest margins. And that is true for some banks, but certainly not all banks, and certainly not the case in the past year when you have the Fed hiking this aggressively. And guess what type of assets a lot of these banks hold? Well, they hold long duration securities like treasuries and mortgage bonds. And when interest rates rise, as you know, the value of those securities go down. So that's really what started this whole thing off with Silicon Valley Bank. They were seeing the deposit outflows, not huge, but outflows just because there was a tech slowdown and they're tied to that space, and deposits were coming out. And so they had this huge book, and they're deciding to sell some of it to go into shorter duration securities, and they book a few $1 billion loss. And that freaked out the depositors very quickly. We can blame social media in part for this. Across Twitter, really, it spread like wildfire. Don't keep your money there. Silicon Valley, all the VC community is a very tight-knit community. They're telling each other very quickly, take money out. We just saw a massive amount leaving the bank in a few days, and that ultimately is what led to its demise. So, yeah, pretty interesting here. Regional bank ETF is cut in half over the last year, and what do you have the whole time? Rising interest rates. It's not to say that rising interest rates are never good for banks, but in this particular case, certainly not a very good thing. So be careful with these kinds of sayings in markets.
All right. And, I guess the actual definition of easy money might be, the money supply. And this is something we've talked about a little bit in the past, but we're finally seeing a change here, right?
There we go, Caleb. This is good news. Certainly has led to a difficult transition for a period of time for the markets and maybe the economy to come. We shall see. But this needed to be reversed. Right? We had this just massive increase in the money supply, 40% increase in 2 years, so 2020 and 2021. Just a massive increase. It was the primary reason why we experienced the inflation spike that we did. And now we're moving the other direction. So that's a good sign. The Fed got the message, right? And hopefully this stays down. I don't expect to see just an enormous pullback like we saw during the Depression. I don't think they want to shock the system that much. But if we have a period of time where the money supply doesn't grow for a period of years and lets economic growth catch up with that, perhaps that's kind of the best case scenario here. So to me, this was a leading indicator of inflation on the way up. and is a leading indicator for, as we've been talking about the last year, of lower inflation rates to come. An interesting thing, Caleb, is I don't know if you ever listened to the FOMC press conferences. It's a very entertaining every single month, because the money supply, the single most important issue when it comes to inflation, is never mentioned. It's like they have to sign something before they get in there. They're not allowed to ask about the money supply. They're not allowed to talk about it. Don't bring it up, because no one ever brought it up in 2020 and 2021 when there was just this unbelievable increase. And now nobody's talking about it on the other way down. There's just this hyper obsession with what is the Fed going to do next? Are they going to hike another 25 days, which really doesn't matter in one particular meeting, right? This is the big elephant in the room that people aren't talking about. And I view it as a positive sign for inflation going forward.
What about the balance sheet, right? So Fed was on a very clear track of unwinding this. Little blip, but maybe back on track.
Yeah, a little hiatus there with Silicon Valley Bank. So they did these lending programs where these other banks, they said, well, how do we prevent another SVB, or at least slow the number of bank failures that occur? Well, they said, well, banks can come to us, give us their collateral, their treasury bonds, mortgage bonds, and we'll provide 100 cents on the dollar liquidity to those banks, through this facility, right? And there's been a pretty sizable increase there in terms of the demand for those loans. And now we're seeing over the last 6 weeks just a kind of reversal. The number of loans hasn't continued to increase, and we're seeing just a continued decline in the Federal Reserve's holdings of mortgage-backed securities and treasury bonds. So kind of rolling that off. So this is tied in to the money supply as well. And so I think the Fed wants to continue to normalize this, but they just had this issue here where they felt like they have to step in. They want to see this come down. Obviously, just a huge increase during the COVID period. They spiked the total assets by over $4 trillion. And now they're trying to wind that off, right? And we've seen the impact, and we'll talk about it in the housing section, when the Fed is not in the market in terms of buying mortgage bonds every single week. Well, now you have more of a free market dictating interest rates there, and you have mortgage rates above 6%. When the Fed was buying like crazy, trillions of dollars of mortgage bonds, they were able to push that rate down well under 3%, which is kind of unbelievable. So this is normalization. If you're bullish on the markets, you don't want to see this spike higher, because it's going to mean there's some type of real crisis, right? You actually want to see this continue to normalize in the months and years to come, but we'll see how far they can get. Historically, the Fed hasn't gotten very far before they've reversed course in terms of trying to shrink the balance sheet. So we'll see.
So you mentioned, everybody just wants to know what the Fed's going to do. Kind of some interesting data you have here that actually projects the Fed rate via futures contracts, like months and years out into the future, right? Yep.
And yeah, as you can see, what the expectation is back to easier money, let's call it. There's not expecting a move quickly back to zero. That would be obviously really problematic, but market saying, Fed is done. So June, July, we have the next two meetings, no change there, but the meeting after that is in September, and the market's saying Fed's going to cut rates 25 basis points then, and then 25 basis points pretty much at every meeting until the end of 2024. And we're going to be back below 3% at that point. So again, depending on your outlook, this can either be viewed as a positive. So let's say the positive scenario would be no recession, right? It just keeps getting pushed out. No recession this year or even next year. Inflation comes back down on its own just through money supply, higher interest rates, lower demand, but not an outright contraction. And now you have this easier policy while earnings are still growing. And I think people will be pretty much happier about that, because we'll talk about later, what this rise in interest rates has done in terms of the consumer. But the negative interpretation would be The market's looking at the yield curve. They're looking at all of these other factors, and the market's saying, we're really on borrowed time here in terms of economic weakness. And the Fed historically, once they see that sign of that the economy is going into recession, they're going to start cutting interest rates aggressively. And that would be a bearish interpretation saying the Fed is going to do it, not because they can do it because of lower inflation, but they're going to be forced to do it because there's going to be a significant slowdown, let's say, later this year.
So whether you view this as a positive or a negative, I mean, is this the effect that's already priced into the stock market? And would you think that any changes from this plan would then be kind of what would adjust the status quo there?
Yeah. So yeah, this is definitely what's priced in today. Now, keep in mind, these expectations are almost always wrong. So nobody, if we look a year ago where they thought the Fed funds rate was going to end up at, they were thinking maybe 2%. So well off that 5% level, right? So take these expectations with a grain of salt. But the question is, how would the market respond in two ways? So to me, the negative surprise would be inflation's coming down. We'll talk about that in a little bit, but if inflation pops back up, there's an unexpected rise, let's say, in the next few months, then the Fed is forced to hike again, right? So this curve shifts. Maybe it stays, but it just shifts higher. That's not going to be received well with the market saying the Fed is done. At least I don't believe so. Or the other scenario where the market is saying the Fed is going to be too slow in cutting rates and there's a real crisis and the Fed's going to do what they did essentially in 2008 and what they did in 2020 was they're not gradually cutting rates, right? They're very quickly moving rates back to zero. I don't believe that's good as well. So this is kind of probably pricing in a more optimistic scenario where inflation gets under control. Maybe there's a mild recession, but it's not bad enough for the Fed to have to say we're going back to zero. So we'll see how this shifts. It's going to shift 100%. It's not going to look the same probably even the next time we talk. It shifts from day to day. Every time there's a new data point, jobs, inflation, someone from the Fed makes a speech, right? This is reacting to that, feeding into that. So don't assume that this is going to happen. The market's wrong all the time, but yes, this is what's currently priced in as of today.
All right. We have had a couple questions come in about the debt ceiling and possibility default, so we will get to that.
Yeah,
it's on the
good,
agenda.
please.
But
yeah.
Before we do, let's talk about the most anticipated recession in history.
Yeah,
another one of your polls, right?
Yeah, this was a good one, and I do this time to time on the economy, but this was probably the most bearish I'd seen people, and probably not all too surprising after last year in terms of what stocks did, in terms of the inflation picture, and any number of reasons, right, for people to be negative, and they were. So this is in December last year, I asked, do you agree or disagree with the statement that the economy is already in a recession or will enter one in 2023? 85%, that's a pretty high number, right? So most people saying we're either in one or we're going to be in one in 2023. And what we were saying last year, regardless of whether anyone calls it a recession, people are feeling like it was a recession, as we'll talk about later, because their wages weren't keeping pace with inflation. So they were feeling that loss in purchasing power and assuming that that's, for them personally, a recession. They may not have lost their job. Some of them did, but not many if you're looking at past cycles. But they were feeling that pinch in terms of losing that purchasing power due to inflation. And so the implication was we're going to see a recession. And so far, Caleb, crowd has not been right. We talked about last year. Remember the 2 consecutive quarters of negative growth?
Yeah.
Well, that wasn't revised. They still had the 2 consecutive quarters of negative growth, but no official recession declaration, right? So now we've had a few quarters of positive growth, including the first quarter here in 2023. So I don't think they're going to go back and say that was a recession at this point, even though there was a 2-quarter economic contraction. So it'll have to be a new one coming up. But the crowd's not the only one really anticipating recession. If we look at the next one, the Fed themselves, this is pretty rare in their minutes. They actually said they're anticipating a mild recession starting later this year. Now, how do they know it's going to be mild? No idea, right? But this is this is highly unusual, I would say, for the Fed to be saying. Usually, they're well late to the party in terms of saying that there's going to be any type of economic weakness. Now, Powell in the last press conference was asked about this, and he essentially said it's not his view. This is the staff's view. So I don't know who that is. He didn't say, but his view is that there won't be a recession. There's still going to be a soft landing, I guess, but there could possibly, he said, be a recession. And yeah, of course, there could possibly. So just interesting here that they're expecting it. The crowd's expecting it. And there's a number of reasons why it's not totally irrational to expect a recession. And this being the biggest one right here, the yield curve, right? And for people who are not following the yield curve, it's simply the spread between longer term maturities, so like a 10-year, and shorter term securities like a 3-month. And when that goes negative, that's not normal, right? Normally you would want a higher interest rate on that 10-year than the 3-month. That's not the case today. And actually a 3-month is 1.88% higher than the 10-year. It's a massive differential. And so what is the market saying here in a nutshell? The market's saying that there's going to be economic weakness in the future. And because of that, the Fed is going to have to cut rates in the future. And if the Fed is going to cut rates in the future, well, those short-term securities that you have aren't going to be giving you that same yield. So what you do as an investor is you go out on the long end and you lock in higher yields. So people going into things like the 10-year and 30-year, buying those on the anticipation that interest rates are going to fall on the short end going forward. So a little bit confusing, but essentially when you have an inverted yield curve, it means that people are expecting lower economic growth, usually lower inflation, and that's the signaling power of the yield curve. And if we look at the last 10 recessions in the US, they've all been preceded by this inversion of the yield curve. But as we talked about at some point last year, this first inverted last October. So I think we touched on it then, but there's usually a lag between the start of the inversion and when the recession begins, and that lag is very variable. So there's no rhyme or reason to when. Yeah.
Very powerful indicator, right? But very bad for timing the market. I think we looked at last time.
Absolutely. Stock market in particular, right? Because the stock market is not the economy. The stock market's a leading indicator as well. But in terms of economic indicators and saying, the odds of a recession are elevated, it's been a pretty good one, right, in the past.
Different types of recessions though, right?
Yeah. So we have a manufacturing sector, which again, manufacturing, not a huge part of the U.S. economy. It's not nothing, but it's not huge. I think some estimates, 12 to 15% of economic growth are from manufacturing. But if you look at all of the manufacturing surveys that we get, and there's a whole bunch of them every month, I just picked one here, Philly Fed. Every time Philly Fed has been at these levels in the past, we've been either in a recession or just about to enter a recession. I think 2001 was the only example where you weren't already in a recession when you're at these levels. Now, again, manufacturing, not the whole economy. So if the service sector is still doing well, it's not enough for just manufacturing to pull the economy into recession. You need services as well. But here, and yet another data point, right? So as you start to pile these things on, we're seeing the not just manufacturing, but I think the next slide we have the housing market, right? And this was going on all of last year, and it's really continued this year. Housing activity really at a standstill. Cause of that, we know mortgage rates spiking above 6%. They're still around 6.4%. And there's just very little activity going on because of that. I think 2/3, I just tweeted out today, 2/3 of the mortgages are below 4%. So if you're in a house and you just bought a house in the last few years, your mortgage rate is below 4%, and let's say you want to move, right? That was a starter home, you want to move to a bigger home, or you just want to change jobs and move a different area, any number of reasons that people will move, all of those things, very difficult today because that person can't afford the home they're living in if they had to buy it today, right? So, which is kind of unbelievable. And that's true for a lot of people who bought homes in 2018, 19, 20, 21 at these low mortgage rates. If they had to buy that home today, they couldn't. So you're taking all of those people out of the housing market equation from both a supply standpoint and a demand standpoint, right? So they're not putting their houses on the market, and they're not going out and buying new homes. And so we've just seen a collapse in activity. And historically, one of the best leading indicators after the yield curve of a recession has been the housing market tends to lead the overall economy.
Yeah, this is really interesting. We talked about this. I went and looked at new home sales, right? So as opposed to existing, and not nearly as much of a fall off. Certainly still down from the highs, but yeah, I mean that spread between new home sales and the strength there versus existing is just what you mentioned. Just another indication of that supply being so low on the existing side,
and so now new homes are making up a biggest share of the market that they've ever made up, right? So if you want to buy a home, a new home is going to be your best bet in many areas where there's building. And so yes, we've seen as a share of the listings that go way up. So it's been pretty interesting to see that, right? And just in terms of the consumer, Caleb, I think pretty much every video we did last year was talking about this was going to be a problem, right? We had that savings rate hitting almost the lowest level ever. We had credit card borrowing rates going up very rapidly. And we said, well, as soon as the consumers starting to feel nervous, or just the combination of higher rates, they don't have as much money, they're going to start to pull back, increase their savings, and we've actually seen that, and probably lower their credit card debt increases, which will show later the reason why they might be doing that today. But now we have retail sales down to 1.5% year over year. And importantly, you have to adjust for inflation, right? So when you have inflation, even, it's down to 5% now, but even at that level, right, you can't compare to last year, because it's going to be sales, the dollar sales are going to be 5% higher just on inflation alone, right? So to adjust for that, we're looking at that bottom panel, and that's been down on a year-over-year basis for multiple months in a row. And if you look back, those gray shaded areas, right, or recessions in the past, when we see this persistent negative real retail sales, it's been yet another recession indicator. So we're just adding them up, right? No, nothing is foolproof, but here's one more, and this is an important one. We've seen this again in past contractions, and here we have multiple reasons why banks might be tightening their lending standards, but I think the second, third, and fourth largest failures in history is a pretty good one. Even not looking at the past few slides that we show in terms of the slowdown in many other areas of the economy, they're tightening their lending standards. And when you're tightening your lending standards, it's harder to borrow, right? And if it's harder for businesses to borrow, they're going to spend less, and spending less is going to lead to a decline in economic activity. So it's pretty intuitive, right? And then that doesn't go on forever. It'll hit a point where it's at the extreme, and then it'll start getting better in the other direction. But we seem to be at levels where in the past you're close to or in a recession, right? And then this this is my favorite one, and Powell actually he didn't reference my chart, but he did reference this term, and he actually took the side saying, indeed, this time is different. He said, essentially, we're going to show this charts on the labor market. That was his argument, that the economy wasn't going to go into recession here in spite of what they've done in terms of hiking rates and the contraction in demand. But historically, that's been a pretty bad bet, because every single time the Fed has hiked interest rates to try to bring down inflation, where CPI was above 5%, inflation did come down, right? But you also got a recession every single time without fail, going back to the 1970 recession. So is this time different? Hard to argue, but the next few charts is really the best case to make, and this is the case that he made. And to me, this is a case to say maybe we're not quite there just yet, but we're heading in that direction. Is that the jobs market today very different, right, than any
Right.
of the other historical periods. Just what happened during COVID in terms of people leaving the labor force and all of that craziness in terms of the stimulus. Well, now people are finally coming back and the job openings are coming down, but they're still elevated. So we have the fewest job openings since April 2021, but you could see that's still way above where we were before COVID. And if you look at the next chart, we have looking at a ratio, right, of these job openings to unemployed people. There's still 1.6 jobs for every unemployed person, and we hit a peak of two times that last year, right? So the labor market is slowly loosening, but I wouldn't say we're there quite yet, and so we could very well see many more months of jobs growth before this kind of resolves itself. And this chart here, we talked about this last year, is the best case to make to say today, like right now, if we look at it, we might not be in a recession because the unemployment rate is a lagging indicator, but is it really that lagging where we would hit the lowest levels in 54 years, lowest since 1969, and be in a recession? Hard to make that case, right? So you tend to see a rise. It doesn't have to be a big rise, but even a rise to, let's say, 4%, that would be somewhat of an indicator, probably saying we're already in it at that point. But for now, there's really a bifurcation, Caleb, in the labor market, where you're hearing about these tech layoffs, right? Again and again, every single company that reports huge, massive layoffs, that's getting a lot of attention. But what people don't realize is those tech jobs are a small percentage of overall jobs, and jobs in the service industry much, much bigger, many more jobs, and there they still need workers. And that's where we're seeing the job gains every single month. So if we're looking at restaurants, hotels, services, professions like nursing and healthcare, we're seeing just slowly that begin to normalize, which is a very good thing. But we don't seem to be quite there just yet, right? And all of this can change, right, if there's some type of extreme event that causes mass layoffs. But barring that, it's hard to say, let's say with the next payroll report, it's hard to predict that would be negative given these factors, right? There's just too many jobs available for the people that are looking for them.
Sure, a lot of indicators to watch here. A lot of kind of warning signs. Any one of these or any two of these you say are really capturing your attention the most in the short term?
Yeah, I don't know about the short term, but the yield curve is the hardest, I think, to ignore, like given how extreme it is. And it's really just saying that the bond market is totally doesn't know what they're doing. They're pricing in something ridiculous, and that you could just throw it out when historically, when you had that relationship, it was pretty bad. And the housing market one is, I think, one that's just simply it's a drag, but it's not going away, right? And we're going to talk about home prices in a little bit, but that's a big factor for people. It's the biggest asset for most households. When they see that going down in value, they're not putting, and we're already seeing that they're not putting as much money into their homes. You look at sales at Home Depot and Lowe's, we've seen a pretty good contraction there. Really, they had a huge boom, so they're not
Yeah.
they're not doing terribly, right? So, but you're starting to see signs, right, of people starting to pull back in terms of their spending, and the consumer spending, Caleb, that is the U.S. economy, right? Once the consumer starts to pull back, that's pretty much every recession in the past, and we're not negative yet on a nominal basis, but as we talked about, adjusting for inflation, we're already there.
Well, let's talk about that consumer, right? Because they're struggling to afford their credit card payments, maybe.
Yeah, that's a good reason. Right? Why? I mean, pay your credit card if you can. Pay it down, right? This is really should be front and center for people. If you have debt, don't even think about investing when you could pay off your credit card and you're getting a 20% return just by paying it off, right? Where are you going to get 20% guaranteed in the markets? You can't, right? So if you have credit card debt, and most people do, I think the last survey was 55% of people don't pay off their balances every single month. So this becomes more and more difficult, obviously, when interest rates go up. And the U.S. government can just go out and borrow more when interest rates rise, but the average person can't. And it becomes a problem where interest expenses just become more and more as a percentage of your monthly payment. You don't want to get in that situation. But we're at the point now where I'd say this is starting to influence consumption. It has to, right? If you're going to think twice about taking on that extra credit card, and likely you saw that chart with lending standards, likely these companies that are issuing this are going to be paying attention and saying, we're going to be a little bit tighter in terms of the line of credit we're going to give people, right? And those factors combined, I think this is going to lead to contraction in spending. I would think it would have to, right? And you know, in terms of where this will go from here, it's hard to see it go very much higher. But even if it stays at current levels, I would think it would be problematic.
Right. And another big component of CPI, and you know, another segment where, you know, consumers spend a lot on autos, right? And rates also rising there.
Yeah, what a difference, right? I don't know if you've looked at buying a new car or used car recently, but we know about the prices, right? They're up significantly, but just the lending rates, what an extreme difference. When I bought a car years ago, there was almost every car was 0%, right? It was free money. Like we had 0% rates for 5 years. It didn't cost you anything essentially to finance it, and the financing companies would actually give you a better deal than a cash buy if you wanted to finance it. So it was a kind of a no-brainer. Well, now that game is over. So with the end of zero interest rates, you have much higher lending rates. And why this is important is that most people finance the purchase of a car. Cars are pretty expensive now. They've gone up significantly. The percentage of people that are spending $1,000 a month on their car payment is just exploding higher. I think it's triple what it was a few years ago. So 7.5%, that's pretty high when just a year ago you're at 4.5%, right? That's a big difference. And like I said, you were getting those deals a year ago where even though that was the average rate, a lot of companies were saying 0% to try to induce you to buy, right? So this has to affect demand. There's really no way around it, similar to the home price situation and the equation there. If you're financing it at 7.5%, well, that's less car you can buy, right, with the same dollar. So we've seen a slowdown. We've seen some companies like Tesla cut prices aggressively to try to spur demand, and kind of Tesla's theory, if you listen to Musk recently, is he just wants to get as many cars out there as possible, really develop more of an ecosystem like Apple. And he's thinking about the benefits of having software in the future with all these people using the cars. But that's a hit to their margins, a big hit to their margins, cutting prices so aggressively.
The question everybody's been asking, everybody's been waiting to talk about this a little bit. It's been all over the news, right? So the debt ceiling and, you know, the expense to cover, you know, those debt payments. Give us the quick take on this one.
Yeah, so we'll start with the debt ceiling. Don't spend any time wasting your time trying to figure that out or listen to the debates because it's all nonsense. It's all a complete farce. If you look at the history of the debt ceiling, every single time it's raised, right? Sometimes they'll wait till the day before. Sometimes they'll do it months in advance. You can't have a debt ceiling when you have a $2 trillion deficit. So if you're borrowing more money than you're getting it coming in through taxes, $2 trillion more, how can you have a ceiling? It doesn't make any sense. Like, don't pass new spending bills, right? So that makes sense. But you already agreed to spend this money, and now you're saying, no, we're going to just cap well, how else are you going to pay for it? You can't. So they will raise the debt ceiling like they always do in the next month, and there'll be another deadline, and then we'll play the same game again. But irrespective of that, this chart is why you can't just keep borrowing money and hoping that this won't become an issue, because at a certain point, if interest rates rise, then it becomes a problem very quickly. So for years and years, Caleb, people are saying, don't worry about the debt. Just look at the interest expense as a percentage of GDP. And because interest rates are so low, this isn't costing us very much. So we might as well just borrow, right? Assuming that interest rates won't go up very much. So needless to say, no one was talking about 5% Fed funds rate a few years ago, right? Or definitely not in 2020. But very quickly now, with interest rates rising every single month, I update this chart. What we see is the expense that the government's paying is going up every single month. And this seems to be on pace to go to $1 trillion just on paying debt, and why that becomes a problem should be self-evident, but it's going to crowd out spending in other areas, right? It's not a productive use of your money to be spending, to borrow more money to pay the interest on money that you already borrowed. So it's going to crowd out spending in other areas. At a certain point, we're getting closer to that. And pretty soon, the single biggest line item in the federal budget is currently Social Security. Pretty soon, this is going to pass that if interest rates really hold up where they are now. Now, some would say that the Fed won't let it get to that point, right? They're tied to this, and they're going to cut rates to make sure this isn't a problem. Perhaps that's the case. Perhaps that's not. The Fed may end up doing it. Maybe they don't. They don't control the whole yield curve. They could try. They could try to do what Japan has done, right, and just buy everything essentially to keep interest rates low. That's not a good scenario anyway. But I suspect that this is going to be a bigger issue in the months to come. People are going to be talking about this in 2024 in terms of the election that's coming up there.
So we've talked about a lot of maybe downside to rising rates. About some upsides.
Yeah. So cash is not trash anymore. There is no alternative. Tina, do you remember that saying? Not anymore. Cash can yield something, and let's start with the bottom there, the average savings account rate, because that's the average, and the average is pretty low because of inertia. People just aren't going out and shopping and seeing that you can get 5% on a savings account. You just gotta go online and do a quick search and find it. Very easy to do. So anyone who's on here that is earning nothing or 0.3%, go out there, link your bank account to that, or you can obviously do a money market fund, any number of things, right? Average 1-year CD rate there, again, that's very low. You can do much better than that. Just shop it around. Or 3-month treasury bills, right? We're over 5%. So 3-month treasury bills tied to the Fed's policy. As long as the Fed doesn't start cutting rates, you could just keep rolling those bills.
Well, plus, if we can get enough people interested in buying these 3-month treasury bills, the yield curve will repair itself, right?
Yeah, exactly. We need to get that huge demand. Exactly. And so this is good news. If you're a saver, you're just waiting to buy a house, or you're waiting to buy a car, and you have money that's parked in a savings account, now you can earn something. And especially for retirees or other people, for years you earn nothing at all. And this is a big change. And now finally, this is above the rate of inflation. So inflation adjusted, you're actually making something as well for the time being. And the other benefit of higher rates, and some people will debate this, but I would say that having a lower inflation rate is a good thing. And if it took higher rates to help it come down, then that's a good thing. Now, I expect this to really come down in the next few months. I'll tell you why. Because in May and June of 2022, we saw a big spike in terms of those monthly increases. Remember, gas prices, we did a webinar where gas prices were over $5 a gallon. That's all everyone was talking about. Gas prices have come way down since then. And so have crude oil, so have a number of agricultural commodities, and many things are much lower. So this year-over-year rate of inflation is going to really drop when we get the report for May and June, because you're going to have those months drop off. So I expect to see low 4% in May, under 4% for June, and then from there it's going to be harder to predict in terms of the year-over-year rate of change. But this is coming down. This is a good thing. If it took higher interest rates to destroy some of that demand to get lower inflation, that was a good thing, because the big real factor here, other than the money supply, Caleb, is expectations. And we talked about this last year, but we needed to crush that expectation that inflation is just going to continue to rise. So people become accustomed to it, right? They say, oh, it's only a few percent increase, which years ago would have been a lot, but now they're getting used to that, and that becomes embedded in the price structure. So you needed to break that mentality. And I think we're getting, if you look at some recent surveys, I didn't put the chart in here, it's coming down. It seems to be coming down every month in terms of people's expectations about future inflation. So that's a good sign as well. And then here we go. This is the chart the most important chart. This is the reason why I agree that with the Fed, with hiking rates as aggressively as they did, because you can't have it prosperity when you have wages below inflation. And we have 25 consecutive months of negative real wage growth. Simply means 25 straight months where inflation, so prices are going up more than wages on a year-over-year basis. This is likely to turn positive in May. So great thing. 25 months, that's long enough. Let's get it in positive territory and let's keep it there.
All right. So moving on to our next topic, and we've talked about the housing market a little bit already, and we are getting a little short on time. So let's go through.
Oh boy.
A little bit faster, but
okay.
No, I'm excited to talk about this though, right? The housing market's been a big topic. So I think you're going to paint a picture though that tells us what expectations should be around housing appreciation and how homeowners should think about that, right?
No question. We'll run through this quickly. Historically, this is going back to 1891. Somehow we have home price data from back then. That's pretty awesome. But we have nominal home price appreciation on average 3.4% a year, and if you take out inflation, 0.5% a year. And if that sounds ridiculously low to people, it's because of something called recency bias, and you see all those high numbers from 2012 through 2022 on the nominal side. Well, people are assuming that home prices not only go up, but they go up a ton, right, every single year. And you don't have to go back very far if you look at 2007 and 2011 there to understand that home prices can go down, and they can go down for years as well, especially when they become very extreme. So let's run through some of those numbers here and set a picture in terms of what people should be expecting going forward. So simply here, last 10 years, home prices almost doubled. Overall, consumer prices up 30%. And if we look at the next chart, we have the home prices by city. And if just scroll over and look at that 5-year and 10-year rates of appreciation, right? Enormous, especially areas like Florida, these what people call these COVID boom towns, areas like Phoenix, Las Vegas became very hot again, just enormous. Even the 20-city index double over 10 years. But now you're starting to see that change. If you look at the right side there, every single city is below its all-time high. You have more and more cities here from Denver, Los Angeles, Phoenix, down on a year-over-year basis. I suspect this is going to continue in the next few months simply because prices got too high and affordability is so low, as we'll talk about. But if we look at the next chart, this will say unequivocally there was a second housing bubble. You can't argue with me on this point because it's exceeded. You can argue with it, but the data won't support your argument because we've exceeded inflation by an even bigger amount than we did during the last housing bubble. And why should home prices keep pace with inflation? Well, very simply, a home should cost what it costs to build it, right? And that's reflected in the inflation rate. It should also be reflected based on people's incomes. And that's usually tends to be around what the rate of inflation is as well, hopefully a little bit above it. But this idea that home prices should diverge to this extent above the rate of inflation for a long period of time means that there's been a paradigm shift. Like all of a sudden, housing is just this special asset class that shouldn't, the laws of economics shouldn't apply in terms of the house price doesn't matter. It shouldn't have any bearing what your income is or what the cost of the house is. It could just go up and up and up. And that's what happens during a bubble. So in this final chart here, maybe we have two more, but housing affordability. So this is the main reason why home prices are down, activity is down, is because there's no demand because people can't afford it. Affordability is lower than it was during the last housing bubble. And then in terms of expectations, people's expectations are way too high on the next chart because we've had this period of real home price appreciation that's really unprecedented, right? In the last few years, 6.6% per year. Haven't seen anything like that. That's not likely to persist. And the expectation, if you're buying a home today, Caleb, and you plan on living in it for 20 to 30 years, anything can happen in the next few years, as we've seen, 20 to 30 years, your expectation should be that it'll go up similar to the rate of inflation in your area. What'd you say?
That's 6.5% a year.
6.5%, right? So I saw a survey recently where people were expecting 10% a year going forward, which is actually interesting because it was similar to the expectations around 2006. So people, it's natural to want to see your home go up in value because it's often the biggest asset that people own, but it's not reasonable to expect prices to go up that much. And importantly here, just a quick point on when you're calculating a return on your home, just keep in mind there's other expenses as well. So this isn't like buying an index fund where your return is your return. You buy a home, right? We're not talking about mortgage interest. We're not talking about taxes. We're not talking about insurance. We're not talking about the cost of repairs and maintenance. All of those things have gone up by extreme amounts in the past few years. And none of these numbers that we're looking at here take that into account. So people will say, well, I bought my home for $200,000. I sold it for $500,000. I made a $300,000 profit. But what about all of the expenses that you incurred? Oh, I did this. I did a 100,000 improvement. I paid taxes, all this. And they never consider that. You have to take that into account, which to me should tell people if you're buying a home to live in it as opposed to renting it out, right? Renting out, okay, you can view what the net income is on that pretty easily after expenses. But if you're buying a home to live in, you shouldn't view it as an investment the same way that you view, let's say, a passive investment like stocks or bonds, right? Because it's just, there's too many factors, that other costs that you're not thinking about. So providing a home, living in a home should provide some other benefit than just this expectation of appreciation, right? So that is one benefit, but keep your expectations in check and buy a home for the right reasons.
But Charlie, I mean, this one always gets me a little excited, gets me talking, right? Because even if your house appreciates and you sell it for way more than you bought it for, unless you're going to go homeless or you had two homes, or, you know, you can go from having a home to cash, you have to buy a new home, right? And then you're doing that at where, you know, like you said, the rising tide kind of lifts all ships. Like all of these homes appreciate. Does anybody win in a in the
realtors?
Right?
No, it's not and I think we touched on it last year, but I'll say my piece one more time, because it's not a good thing to encourage a house price bubble. You don't want to have a situation where homes are extended relative to people's incomes, because it's not a productive good. Like your house going up in value, there's no productivity gain there. You can't export that to another country, right? It actually does the opposite, because now people are spending more on their home as a percentage of their income, and they're crowding out investments in productive areas. They're crowding out savings, right? So it's actually the opposite. You want housing to be affordable. I mean, it's a cliche, but affordable housing is like a cornerstone of having a prosperous country, having a good economy. You don't want to have this situation. And really, if you're living in a house, you don't expect to flip it, right? So I guess you say, who benefits? Well, someone, let's say, who lives in New York or California, and then they move to, let's say, the Midwest, right? Maybe that person benefits because they could sell the house, and retire in a lower price area.
Now they get to live in the beautiful Midwest.
That's right. Correct. So that's a benefit as well. But that person might bet, but that's a unique situation, right? And that's for most people, you don't want to see while you're living in it. You don't want to see it go up, because when it goes up, you get taxed more, right? You're assessed based on the value of your home. When it goes up, you have to pay a higher rate of insurance on it. When it goes up, that probably means that it's going to cost more to repair it, right? Because that means inflation has gone up. So it's counterintuitive, but not that you don't want your house to go up in value. That's fine to want it to increase over time, and it likely will, just with the inflation, right? As well, when you print money the way we have, everything becomes worth less, but it seems like it's worth more. So it's fine to want it to go up, but this idea that it's this wonderful thing if you don't plan on moving, and like you said, even if you're going to live in the same area, you're going to trade up, right? Well, then that house that you're trading up to is now gone up as well, right? So it's a fascinating thing to hear people, because it's a very psychological base, right? Everybody is really attached to that home price, and they think that their home should go up in value more than everyone else's.
Indeed. All right. Well, you talked about that psychological feeling, so let's talk about maybe a little bit more of
So
a topic.
investing resolutions, Caleb. Any resolutions coming into this year, and have you stuck with them?
I haven't. I mean, the only resolution that I made and kind of made public was to invest more in my friendships, and you know, I don't think I've done as good a job of that as I wanted to. So
Okay, there's still time. There's still time. So what I would say, well, then that's a good one. Most people's resolutions usually are to sleep more, eat better, lose weight, exercise more, right? Spend more time with friends and family. All of those things, all good things. And usually they forget about them a month in, right? If you look at gym memberships, a month after the end of the year, they start to go down, and they continue to go down until January 1st the next year in terms of attendance. They're still paying that for that membership. They're just not using it. So in the investing world, I have 4 things that I say every year. People say, well, what should I do with the market this year, right? We're trying to figure out what exactly the market's going to do this year. And they're almost always wrong, right? Those predictions. So just throw them out and just think about 4 longer term things that you can apply to any year. And number 1 would be, if you're a long-term investor, embrace risk. And really, if I had to show someone one chart of why you should think about investing, it would be this one, because there's inflation. And even though it's come down and hopefully it continues to come down, I don't think it's going away. And so the purchasing power of your dollar, if you're just keeping your money in a checking account, not earning anything, or under your mattress, it's going to erode, as we've seen here year after year. And stocks have been, over the last 100 years at least, the best real inflation adjusted asset class, right? So you want to have something that will keep pace with inflation, hopefully exceed it. The short run, no one can predict what that asset class is, but in the long run, things like stocks, commercial real estate, etc., have not only kept pace with inflation, but exceeded it. And the trade-off there is pretty simple. You have to take more risk, right, in order to get it. It's much safer, obviously, to keep your money not under your mattress, but you don't want to do that. But in a checking account, feels very good. It's not going to ever go down in value, but it won't keep pace with inflation. And inflation is a very quiet thing. It just creeps up year after year, and then all of a sudden, your dollar is worth 20% less. So you got to be very careful. Think long term. Embrace risk. Now, playing the long game, Caleb, very important. Now, if you turn on financial TV every day, they're always talking about what's going on today. Was the market going to be up today, down today? Who cares, right? It's a coin flip. If you look at historically, a market on a daily, any given day is up a little over 50% of the time. So it's like blackjack, maybe a little bit better than blackjack, or roulette, right, where you have close to 50-50 odds, right? That's not good odds. And if you're an investor, the longer you invest, the better your odds. So over a 20-year time period, there's never been a period where the market hasn't been positive. And more importantly, the growth compounds with time. So what I have here is average growth of $100,000 portfolio. A lot of people always talk about 10,000, but hey, there's inflation. So I gotta adjust for that. You're starting with 100,000. After a year, you got 111 on average. Not bad, pretty good. And you may feel like, oh, I'm going to cash out there. Don't cash out, right? If you look at 10 years, you're tripling your money. 20 years, more so. 30 years, if you can just stick with it, historically, you've done pretty well. These are average returns.
And how often do we get to say things like never, right?
What's that?
I said, how often do we get to say things like never in finance? You said there's never been a 20-year period.
Even if you bought in the peak right before the Great Depression, you would have a positive total return over the next 20 years in the stock market. It would have been not an easy thing to hold on to, but stocks were down over 80%. But 20 years later, and that assumes a lump sum, right? So if you're buying every year, and you had money during the Depression, which not many people did, you would have done better. This is a simple one, boring, right? But diversified, because you can't predict. You look at all these asset classes, right? You have a diversified portfolio. We want to pick that winner. We want to know every year, is it going to be Bitcoin? Is it going to be the NASDAQ? Is it going to be US stocks, international stocks, bonds, cash, right? What's going to do the best this year? No one knows, right? But over the next 10 years, you have a diversified portfolio, you're likely to withstand almost any type of outcome, right? And that's really what you're trying to do as an investor. Diversification is not about getting the best return. You're guaranteed not to have the asset class that does the best because you have a little bit of everything. So you're always going to have something that underperforms, but you do it because it's an exercise in risk management, because you don't know what the rest of 2023 is going to look like, or 2024, the next decade, right? NASDAQ 100 since 2011 has done 16% a year. That's fantastic. Pretty good. You can't do much better than that. Is probably, you can count on one hand the investment managers who have beaten that. Very few, right? And they were probably invested in those same companies and just more concentrated, right? But is the NASDAQ 100 going to be the best in the next 10 years? Probably not. If I had to venture a guess, probably not. I don't know that for sure, but I think I'm willing to bet that there's going to be some mean reversion there, and it won't be. And so on the off chance that what's the best today is not the best tomorrow, that's why you invest and you spread your risk. So pretty simple concept, but why it's not easy is because if you diversify, you're not going to have that shiny object, which is the thing that's doing the best, right, in any given point in time. You're not going to be fully invested in that.
All right. So embrace risk, play the long game, diversify. And lastly,
and the most important one here is focus on what you can control, and what you can control, not easy, but what you can control is your emotions. And what are the two big emotions in markets? Fear and greed. And what do fear and greed cause us to do? Well, they cause us to do stupid things like buy high and sell low. So this is simply a chart showing you the investor return, average investor return in various mutual funds versus the actual funds return. And as you can see in every single category, what's lower? The investor return. Why is it lower? Because the timing of the investor flows. When do the investor flows come in? Caleb?
top.
That no question, right? Yeah, you want to buy the thing that's done well, right? And if there was persistence in performance, that would work pretty well. But unfortunately, as the disclaimer says that no one reads, past performance not indicative of future results. So that fund that has done the best in the past is actually more likely to do a little bit worse in the future. And so when it actually does worse in the future, people then sell out. They buy only after the gains, and that's what's known as the behavior gap. That's costing investor returns. Their emotions are costing them, right? And it's both the fear on the downside and the fear of missing out. Gosh, how much did we talk about that in late 2020, early 2021? No one talking about any of that stuff today, right? SPACs and IPOs and meme stocks. When was the last meme stock? I mean, Bed Bath and Beyond went bankrupt, right? That was one of the big meme stocks that everyone was loving. So do those four things for life, and you'll be okay as an investor.
All right. Well, we made it to the end, Charlie. Thank you for going a little bit over time here.
Sure.
Just because we promised, let's take one question.
Please. Yes.
That we did the Q&A. We've got several here. Here's a good one, maybe an easy one to answer. Somebody wants to know how much time you spend on your charts of the week email every week.
A lot of time, for sure. And it's a culmination of just everything that I'm thinking about, reading during the week, and trying to paint a picture, a story around that, right? So not just showing the charts, but creating what is the narrative behind all of those things, and wherever possible, how can you tie it in to becoming a better investor, and really trying to separate the signal from the noise in it. And a lot of the stuff is very interesting, and I'll be the first one to say it. It's fascinating, it's interesting, but 99% of the stuff that we consume is not actionable, right? And even the stuff we're talking about today, it's all very important. Don't get me wrong. It's extremely important to know how the economy is doing, what's going on with inflation, all of these things. But it doesn't necessarily translate into saying, here's something you should be doing as an investor right now because of it. And that's the temptation. That's what you try to avoid. But it's a lot of time. It's a labor of love, though. I love putting together not just the charts email, but all different things that I write about and try to communicate. And really, two real goals. One, making the complex simpler, right? And I know YCharts is big with that, and I try to use as many of the YCharts visuals as I can to really display that and try to help investors not fall prey to those emotions, right? That often get the better of us. So, good question. I don't think I've timed it. Maybe I'll do that next week, but
Any recommendations? So I think we have a lot of listeners, a lot of other YCharts users who, they want to do something like that for their clients. Any approach that you would recommend to take to, somebody else to package up some charts or some information on the markets every week, every month, and send that out?
Yeah, I'd say talk to your clients, see what they're interested in, what's driving them, and what are you yourself interested in? Because you're ultimately going to be a better writer, better communicator in things that you like and want to learn more about, want to understand, and to really help your clients, you have to understand what are things that might become what's front and center for them, even though it may not be important as you think. If it's important to them, it's important, right? So with this whole thing about the debt ceiling, for example, I'm gonna be doing a video on that next week, and it's not because I think that anyone should be doing anything about it, but it's because people are asking about it. They're being inundated with that information, and it's helpful to put it in some context. This is what's happened historically. This is how stocks have done around the debt ceiling. This is how bonds have done. These are kind of the possible outcomes here. And this is why, as an investor, you don't need to panic and say, let me get out until the debt ceiling crisis is resolved, right? So things like that. I think a combination of letting your own interest drive it, because ultimately, if you're not interested in a subject, you're not going to spend the time to make it interesting for the people that are reading it. And also listening to your clients, listening to what they're worried about, because even if you don't do that as a valid fear, not everyone's living it day to day, right? So most people just get a very quick glance at what's going on. I don't know what's the big, if they're getting information on Twitter, they're getting information on whatever their social media is, maybe they're still watching financial TV. It could be any number of places they're getting information, and that information they're getting has a variety of viewpoints, and it might not all be the right thing they should be hearing. So I think the best argument to make that you should be putting out something to your clients is just to say they're getting it from you, and now like you're building that trust with you, that they're hearing something and you're giving your opinion on it. Not that you know what's going to happen, but you're sharing why they should or shouldn't be doing something based on that, right? And gosh, that alone is valuable, right? That alone for clients is valuable because of that behavior gap that we're talking about, right? So if you can help them not make the mistakes that everyone else is making in terms of letting the emotions get the better of them, that's adding huge amount of value right there.
All right. Well, thank you. This is great. Looking forward to getting back onto a more normal cadence with you, Charlie. Again, not congratulations, but we're happy
Absolutely.
for you with the career move.
Thank you.
And yeah, I guess maybe the other tip I would recommend is use Charlie's charts. It's a good way to get in touch.
And we get to talk about eggs, Caleb, but we'll leave that for next time.
We'll leave everybody on the edge of their seat. We'll talk about eggs next time.
Good.
All right, Charlie. Thank you.
Thanks everyone. Appreciate it. See you, Caleb.